2 hours ago, a single Truth Social post moved more money than most countries earn in a year. At 7:05 a.m. Eastern on Monday, Trump posted that the US and Iran had held productive conversations toward a complete and total resolution. Oil, which had opened above $114 a barrel, plunged 13% in minutes. S&P 500 futures, which had been down more than 1% before the post, surged 3%. Nasdaq 100 futures jumped the same amount. Dow futures rocketed toward a 1,000-point gain. European stocks swung from losses to gains. US natural gas prices fell 6%. European natural gas futures slid 9%. Heating oil dropped 12%. All of this happened before anyone had verified a single claim in the post, before Iran responded, before the IDF confirmed it was still bombing Tehran, before a single analyst had confirmed what the productive conversations actually produced. Less than an hour later, Iran's foreign ministry said there were no talks. The Iranian parliament speaker called it fake news designed to manipulate financial and oil markets. The Dow's intraday surge of nearly 1,135 points contracted to 540 before recovering to close at 631. Oil settled at $99.94, down sharply, but still more than a third above where it stood before the war began on February 28th. What happened on Monday morning was not a market reaction to a geopolitical event. It was a market reaction to a Truth Social post. And the difference between those two things is the most important financial story of the entire 25-day war. What Bloomberg called the clear message, and what it actually means. Bloomberg's headline captured the mechanism precisely. Trump's wild 5-minute rally sends clear message to Wall Street. The message was not that peace was imminent. The message was that Trump at least wanted the market to believe peace was imminent, and that in the current environment, Trump wanting something is sufficient to move global capital by hundreds of billions of dollars. UBS economist Paul Donovan had described the dynamic in a note published Monday morning before Trump's post. Investors have two related problems in pricing risks around the Gulf War. Statements from top U.S. administration officials give different and at times contradictory assessments of the war. In the absence of measurable objectives, this is all markets have to respond to. The result is volatility. That diagnosis is precise. There are no measurable objectives against which to assess progress in this war. Trump has described Iran as obliterated, then as holding leverage over the global oil supply. He said he was winding down the war on Friday, threatened to destroy power plants on Saturday, announced productive talks on Monday. Hegseth said on day 11 the U.S. was winning decisively. The IEA said on day 24 the energy crisis was worse than 1973 and 1979 combined. Both statements exist in the same market simultaneously. The result is that what moves markets is not facts. What moves markets is presidential intent, specifically the inference that Trump's willingness to signal de-escalation means the worst outcome is being avoided, regardless of whether the diplomatic claim behind the signal is accurate. E-Trade's Chris Larkin summarized the investor position. The market woke up to some potentially good news out of the Middle East on Monday, but follow-through on any relief rally will likely require tangible follow-through on the geopolitical front. We're still living in a headline-driven market, and with a light economic calendar this week, the focus will remain oil prices and politics. He was describing a market that knows it is being moved by headlines, and continues to move anyway. What the relief rally did not price. The physical reality behind the numbers. The divergence between what the market priced and what actually happened on Monday reveals a structural vulnerability that nobody in Washington appears to have fully accounted for. The Strait of Hormuz remains closed. CENTCOM confirmed Monday that the waterway is physically open, but that Iran is firing missiles and drones at any vessel attempting to transit. Over 3,000 ships are anchored in the Persian Gulf, waiting for a resolution. Goldman Sachs, which revised its oil forecasts sharply upward the same day Trump's post collapsed them, made the actual situation explicit. If Hormuz flows remain at 5% of normal capacity through April 10th, prices will trend higher. If disruption lasts 10 weeks, daily Brent prices will likely exceed their 2008 record. S&P Global's energy analyst Kurt Barrow described the physical reality that the market's relief rally did not resolve. The energy crisis is moving really into a demand or availability crisis. We are short about 15 million barrels a day, not just crude. We are short jet fuel and diesel and will be short gasoline. He added that whenever the conflict ends, it will take months to re-equalize the global energy system. The IEA confirmed this explicitly. 44 energy assets across 9 countries have been severely or very severely damaged since the war began. The agency released a record 400 million barrels from strategic stockpiles on March 11th and said Monday it was consulting governments about releasing more. The strategic reserve release, the largest in history, bought time but did not solve the underlying supply disruption. It cannot be repeated indefinitely. Goldman's note was not about what the market was pricing. It was about what would happen to supply if the strait stayed closed regardless of what the market was pricing. Wood Mackenzie analysts said $200 a barrel oil is not outside the realm of possibility in 2026 if disruption is prolonged. The market on Monday moved as if that scenario had been taken off the table. The strait was still closed when it did. Which sectors moved? And what the gap between Asia and New York tells us. The specific sectors that moved most on Monday tell the story of what the market was really pricing. Norwegian Cruise Lines surged 6.2%. United Airlines climbed 4.5%. American Airlines rose 3.6%. The Russell 2000 index of smaller domestic companies, the most sensitive to energy cost and consumer confidence, jumped 2.3%, the strongest gain of any major index. Companies with large fuel bills led the rally, because the single thing a de-escalation announcement changes most directly is the forward price of oil, and therefore the operational cost of airlines, shipping companies, manufacturers, and every business that moves physical goods. The S&P 500 finished the day within 5.7% of its all-time high set early this year. Asian markets, which had closed before Trump's post, told a different story. South Korea's Kospi fell 6.5%. Japan's Nikkei dropped 3.5%. Hong Kong's Hang Seng lost 3.8%. The Asian session was pricing a war without a de-escalation signal. The New York session was pricing a de-escalation signal without a war ending. Both pricings occurred on the same day. Towards the gap between them is the risk premium that now lives permanently in global markets, a number that rises every time Trump escalates and falls every time he signals de-escalation, regardless of whether either signal reflects operational reality. Treasury yields, which had surged on inflation, fears driven by oil prices fell after Trump's post and remained elevated. High yields were a factor Trump named a year ago when he backed off initial tariff threats, and critics quickly noted the parallel, the taco pattern, as some describe it. Trump always chickens out when markets show enough pain. Whether that framing is accurate or unfair, the behavioral pattern it describes is now priced into global markets as a feature, not a bug. The war is in its fourth week. The strait is still closed. 44 energy facilities across 9 countries have been damaged. The IEA says the crisis is worse than the 1970s. Goldman says prices could break 2008 records if disruption continues. And on Monday, a single social media post sent oil down 13% and equities up 3% in 5 minutes. The Hormuz is still closed. The 5 days have started, and somewhere between $90 and $200 a barrel is the answer to every question the market does not yet have.